right, welcome to the Money Puzzle. I am Brian Ramsey, and in front there's Eric Douglas, and then back here is Chris Vaughn. And as always, we're going to talk about kind of markets, but this is a new year, so it is January of 2023, the first one. We took a little bit of a hiatus there in December, scheduling conflicts, people taking vacations, things like that. So we didn't quite keep these on a regular basis.
Doesn't everybody take a hiatus? That's true. I mean, we were coming into the office the week between Christmas and New Year's, and it's impossible to get anything done because nobody's working.
Yeah, the running joke is in between Christmas and New Year's, you don't even know what day of the week it is.
Well, you didn't come in here.
No.
No, I actually saw you.
I came in and picked up a couple things, but I was just vacationing at home, if you will.
Yeah. All right, so here's what we thought we would do today, and that is sort of give an outlook for 2023. Maybe a few discussions on what happened in 2022, but really going to focus on 2023 predictions that we have, maybe predictions that other folks have. That we watch, and so we're kind of getting their thoughts, and we thought we would share them. So I'm really going to focus on these two guys today and let them sort of give their input on where we're going to be. So let's start off with what do we think the S&P? S&P 500 is.
You want to talk about what we think it's going to be this coming year, or what people thought it was going to be?
You can do either way you want, but we obviously know what happened last year, down 19%.
Yeah.
Right. So ugly year. Although it would have been a lot uglier had we not had November, December, because November, December are pretty good months.
Yeah.
But talk about it however you want to talk about it, but sort of give your outlook on what you think is going to happen in the markets next year.
Well, I think we probably want to preface it first too by saying we're doing this in fun, right? Because nobody knows anything that's going to happen. And I think the whole impetus for doing this was because looking back at some of the predictions for 2022 made at the beginning of the year by the largest investment firms on Wall Street were demonstrably wrong, not even close, horribly wrong. And so I wrote down some of those numbers because Goldman predicted the S&P to finish the year at about 5,100, Wells Fargo 5,200, Chase about 50. Oppenheimer actually went 5,300. The S&P finished about 3,839. So way below what expectations were.
And it started, we were talking about this before we started recording. We couldn't remember what the starting number was, but it was around 4,000, 4,100, something like that.
It was over 4,000.
Yeah.
I want to say it was around 4,200 maybe, something like that.
Yeah, that sounds about right.
But down, it finished down 18.9, right. I think.
And all four of those that you mentioned were up big. Those were significant advances. And we had a significant, backtailing. I found another article in the New York Times that said that the average Wall Street firm at this time last year predicted that the S&P would be at 48.25. So that's lower than those monsters that you got, all of whom are very respected, investment firms. But I think that leads to the point that you were making, Eric, was nobody has any real idea what's actually going to happen.
Yeah. Well, it's interesting too because a year ago, all of these major investment firms were super bullish.
Yeah.
And thinking that we were going to have just another great growth year, continue, what had happened the previous 3 years. Their predictions for 2023 are all basically flat. So, Goldman's predicting a flat year. Wells Fargo's predicting a finish of the S&P 500 between 3,800 and 4,000, which is basically flat. Chase is predicting 4,200, which is up a little bit. Actually up quite a bit.
Actually,
that one's up pretty. Yeah, that one's actually up quite a bit. So we're probably predicting about 15-20% return there for Chase. But, I mean, it just goes to show you no one has anything, no one really has any idea. And what's funny is that all of these predictions basically fall in line with one another. There are very few Wall Street firms or very few big-time investors that really want to step out on a ledge by themselves and make any kind of a bold prediction. So that's another thing that I found interesting as you start the new year reading all these predictions for the year and what people got right and what people got wrong. And everyone guesses the same thing. I just find that interesting.
I found another one while we were kind of doing some research beforehand, and this was done at the end of February. Well, we already knew at the end of February 2022 that this was not going to be a good year.
Nope.
This was going to be rough. And this particular individual, I won't mention names, predicted a full market meltdown, like to the point of dysfunction, by the end of June. Okay, so the first half of this year was not fun, no question about that.
Wasn't that bad.
The market's still there. Right? And that's I get frustrated when I hear the doom and gloomers. The whole thing is just going to end. we've heard that one before, and it's
Yeah. You watch too
it
much
was a
news
rough
media.
year, but
and,
it was it's still there, and that's where people get upset, and you hear advisors talking about people are saying, "I've lost so much money." If you didn't sell, you haven't lost anything. You just have to ride these kind of things out, and you have to understand that when you're looking for that soothsayer that's going to tell you this is what's going to happen this year, at best, it's an educated guess.
Yeah, here's the one thing I always question about these predictions. And you get them at the first of the year because everybody's sort of giving their outlook. Hey, here's what happened last year, but here's really what we think is going to happen, in the coming year. But you get different snippets about the market during the year. Mm-hmm. So as an example, I always go back and I think I post this on LinkedIn. So if you follow me on LinkedIn, go back and look. I think it's a couple posts ago where I believe Jamie Dimon came out and said, or somebody came out and said, we're gonna, market's gonna be in recession, blah blah blah. And I'm like, why would he come out and say it then?
Right.
We weren't in a recession. We were actually technically out of a recession at that point. The fourth quarter, we'll get those numbers coming up in about 3 weeks, but the third quarter was better than expected. So why would he come out in the middle of a quarter and say there's going to be a recession? Well, it ultimately comes back to you have to go back and look and see what their holdings are. And why are they coming out and making certain predictions? It's all these hedge fund guys you see on CNBC.
Yep.
When they make a prediction, you really would want to go back and see what their holdings are. And the reason why hedge fund guys can say that is because they don't have to disclose what their holdings are. So they can come out and say, the world's coming to an end, recession. But if you go back and look, I'll bet their portfolio is loaded with put options.
They're short. They're short in something.
Oh, yeah.
Yeah. And it's like, they're all, anyway. So I say that because you get some predictions. You guys were talking about people being bullish or people being negative. Take that with a grain of salt.
Yep.
Right? Take it because there's probably portfolio holdings that they are counting on to go one direction or another. And that's why they give those predictions.
But,
all right. Go ahead.
I was going to say, just going back, the predictions. What do we think is going to happen this year? And I don't know if anyone will start. I'll throw my hat in the ring. Looking forward for the next year, I think we're going to have, I don't know if it's going to be a flat. I think probably by the end of the year, it wouldn't surprise me if we're up maybe 5-6% as a whole. But I think it's going to be pretty choppy throughout the year.
You and I were at the same lunch, and we were talking about, his name popped out of my head, the big economist with First Trust.
Brian
Westbury.
Brian Westbury, thank you. And we were talking to a guy that actually, knows Brian. And the prediction that Brian had made for this upcoming year was, to your point, very choppy. It will probably be up, but it will be a minimal amount. But it's going to be a little bit of a roller coaster ride to get there, and you're not necessarily going to feel good. That was his prediction, and he's been pretty accurate when you look at him big picture. So I'm going to kind of go along with what Eric was saying.
Well, I think ultimately, because a lot of this, and I hate to say it because no one likes the fact that governments and markets are so intertwined now, but that's kind of the reality that we live in at this point. And a lot of this is going to be dictated by Fed policy, and I know that's one of our agenda items here on the sheet there. But we never know. The Fed could come in and start chopping rates, and they start lowering rates all of a sudden overnight. Guess what's going to the market? That's going to dictate what the market does. If they continue to raise rates at the pace that they've been doing it, I don't think that they will. I think they finally hit maybe not a ceiling, but I think we're getting pretty close to a ceiling as far as rates are concerned. There's only so far the market can go up if we continue to raise rates. Right. So I think we're trying to find a little bit of a middle ground right now. And that's why I think at least especially through the first half of the year, I think we're going to be pretty choppy because we're still trying to find out, okay, are we in a recession? Are we not? What's the Fed going to do? Are they going to raise rates? Are they going to hold them? And there's still a lot of unanswered questions, and I think we'll have a lot more clarity around summertime.
Yeah, I'm going to go. I think we're going to be somewhere in the high single digits. And I think the majority of that performance is going to come at the end of the year, which will lead us to the recession talk.
Yeah.
Because that's sort of one of the talking points that happened at the end of last year was, are we going to be in a recession next year? A lot of people have been predicting it. We've had lots of conversation with clients about what our thoughts around whether we're going to be in a recession. Matter of fact, last night we were at lacrosse practice and a guy came up and said, "Oh, we got to hunker down next year, and it's not going to spend. We're not going to go out to dinner, and we're going to save money." And I'm like, "For what? For what? Why would you? Why, for what? What gives you what makes you think that?" Well, I read and I watch and I go, "That's your problem. That's your problem." And I was joking with him, but then again, I really wasn't. And we even tell clients that be careful where you get your information, because depending on what information you consume will predict whether you think we're going to have an awesome year like this 5,500 on the S&P or whatever it is, or we're going to be 2,500 on the S&P.
Yeah.
Depends on who you talk to. I personally feel like next year we're going to be in a recession. I do think fourth quarter is going to be in line with where we were in third quarter. It may be slightly higher. I think it's going to be that way because
fourth quarter of 2022?
Correct. Yeah, fourth quarter of 2022. Yeah, because if you went out at all and did any shopping out, parking lots were packed.
Yeah.
And they weren't. It was jam packed. So I think the consumer came out of pocket, which is good. That's a good thing. But I think going into the first quarter, I think they're gonna be like, all right, we spend everything in fourth quarter. We're gonna slow down our spending or consuming a little bit. So I think we're gonna see what we saw last year. First quarter was down a little bit. Second quarter down a little bit. So technically, we'll be in a recession. Mm-hmm. But I don't think we're going to be in this wholesale mass layoffs, and I don't think we're going to see any of that.
Well, I think to piggyback on that, so you're talking about going into a recession next year, which I think we probably will as well. Here's the reality: the market's down almost 20% in 2022. Mm-hmm. I mean, just a hair shy of 20%. The economy was not that bad. The market is typically a leading indicator.
Yep.
So usually, I think what's going to be interesting is we're going to get the official recession news, maybe first, second quarter, who knows? I don't know, but I think it's probably coming. But it's going to be interesting to see how the market reacts to that, because I think a lot of that's already been priced in. I think so much of this year with the raising interest rates and the fear of a recession has driven markets lower. That when we finally get into the recession, and we've talked about this kind of throughout the year, that they're trying to put us into a recession, that once it finally happens, once we finally get that bad news and like, oh, okay, we're here, we can start moving on. And I think I almost would expect that once that happens, we're going to see a rebound in the markets, which will be a weird dichotomy, of course. But that's how these things work.
So we're sort of predicting that we will be in a recession, but just may not be this awful, where unemployment, awful recession where unemployment goes up, 10%. I don't see us getting there.
Well, that's going to be the other thing to watch too, because employment is going to go up. I don't think it's going to go up horribly, but like Amazon just announced, this is timely. Amazon just announced like yesterday, I think 17,000 layoffs or something. It's some really big number. But they actually referred to Twitter when Elon Musk came in and bought that. He's like, we cut 75% of the workforce, and basically the product's the same. Amazon's doing the same thing, but they're predicting about $3.6 billion worth of retained earnings, saved earnings, because they're just cutting their workforce. So it's going to be interesting, because you're going to see workforces cut, because there's probably excess headcount at a lot of these major firms, but you're going to see earnings go up. So when earnings go up, that has a positive effect on the market. So it's going to be, once again, you're going to see bad news over here, but that bad news could actually translate into good news in the market.
It's all perspective.
Yeah,
it is. Okay, inflation. What do we think inflation is going to? What do we think it's going to do in 2023 compared to 2022, or compared to however?
I think it's going to be similar. To be real honest with you. It takes a couple of years of inflation to catch up to the values that we had. Everything was overinflated. Now we've got to catch up. We had, 12 consecutive years of exceedingly low inflation rates. Mm-hmm. There's some pain to catch that up to average. So I don't think it'll be quite as high as it was in 2022, but I think it's still going to be high. I think it's still going to be painful, and I think that's going to have a big impact on we're going to talk about Fed policy, stuff like that. That is going to have a big impact this year.
Go ahead. I'm sorry.
No, go ahead.
Well, I think inflation has peaked, whatever that means. But I think the rate at which it increases has stopped.
Yes,
I agree. I think it's going to stay flat. I don't think people can expect to go to the grocery store and start paying less. That's not going to happen. I don't think we're going to have any kind of real serious deflation. I think it's going to stay largely flat probably throughout the rest of the year. I think a lot of that is going to be based on Fed policy too, of course. But I think we've seen 4 months now in a row where inflation is very, very slightly coming down. And when I say it's coming down, I mean it's coming down about
as compared to
0.2, 0.3 percentage points, right? But once again, inflation is still very much a problem because prices have increased so much. Mm-hmm. When I say it's peaked, I think the rate of increases, I think it's going to stop going up further, but it's not going to come down.
No.
That's kind of my
Agreed.
prediction for the year.
Well, so you have when you talk about inflation, and I posted something on LinkedIn. So if you don't follow me on LinkedIn, just go back and check. I think I may have posted on Facebook as well. But when you look at inflation, you can look at it from a variety of perspectives. You could say, oh well, when I was going to Kroger 2 years, let's say prior to 2020, I could fill up my basket and it was $120. Now it's 170, and I'm not quite filling my basket up with the same stuff. That's real inflation.
Oh, yeah.
That means you're paying a lot more. If you look at these federal numbers, and I say, numbers that are posted, CPI
Right.
numbers, whatever, when they say that inflation is coming down, it's technically not. It's not.
Yeah.
Because they're doing year over year.
Right.
So even though the number, they'll say, oh, inflation came down. Well, no, technically it didn't, because if you go back and look at the year over year numbers, inflation was going up last year. So even though so your denominator, if you will, so last year's numbers are going up.
Yeah.
So if you do every year over year, saying, oh, it came down, down to 7.1. No, it technically didn't come down at
Right.
all.
Exactly.
Because the denominator's going up,
Mm-hmm.
if that makes sense. So you gotta have to keep all this in perspective.
The rate of increase, right? It's kind of like baseline budgeting. So, whenever you give a department a certain budget for the year, and then they increase the budget for the next year, then they maybe cut, let's say you raise the budget 5%, and then from that they don't spend it all. They say, well, we cut spending 2%. Well, no, actually you raised it 3%.
Yeah.
Because
Exactly.
technically it was 5, you had a 2% cut from the 5% increase. It's kind of the same idea with
It is, yeah.
inflation. Yeah, so the rate of increase is slowing down. It's still very, very high.
Yeah. And the second thing that we all have to keep in perspective, and I've had this conversation with clients over the past year. When you're talking about inflation, it means that the price of a good and services is getting higher, getting more expensive
Right.
to buy the same good or service or consume whatever you're consuming, right? It's no different when you're looking at what happened over the last couple of years. Yes, I think to your point, we really had no inflation for a long time. Then all of a sudden we got whacked at one
Yep.
point. But income has also steadily gone up. Because I remember years ago, people would say, oh, you make $100,000 a year?
That's a big deal.
God, that's a huge deal.
Yeah.
And now,
So you're a millionaire then, right?
right, yeah. But even now, the majority of people that come in here pretty much making $100,000 a year. So, but you have to also keep in perspective, if you go back and look at history, I'll use my dad as an example, okay? Dad's 81 years old. In 60 something, 59, 60, whatever, his very first job, $4,300. That's what he made
For the year.
So he made that was his annual salary, $4,300. But his first house cost $6,200, and he bought it out of a Sears magazine. So it's all relative, right? Now you flash forward, he was an accountant. So an accountant coming out first year is going to make $100,000 a year
Yep.
at a big firm, if not more. But the first house that they go buy, a 3-bedroom, 2-bath house, is going to be $400,000. It's no different than when my kids are my age or my kids are my dad's age, and they're 80, and our starting salary is going to be $200,000 or $300,000, and the 3-bedroom, 2-bath house is going to be $900,000. So it's all relative, right? That's why we got to keep all this in perspective. And the inflation thing just gets blown way out of proportion. And I think people use it to they use it to whatever talking points that they have. They can use it as something that's good or something that's bad. It just depends on what they're trying to push.
Hyperinflation is bad for sure, but regular run-of-the-mill inflation is actually healthy for the economy.
Yep.
Yeah,
Sure is.
Well, and if there was no inflation, guess who's not getting a raise?
Yeah.
Right.
People are not getting raises. So anyway, enough on recession. I kind of beat that one up a little bit. I'm sorry, inflation.
Inflation, yeah.
Let's talk about Fed policy.
Yep.
Because that's kind of a hot button, right? I mean, so let's sort of give your prediction on where do you think the Fed, what do you think the Fed's going to do this year?
I think that this time of year from now, the rates will be higher than what they are now. I think they're going to continue to increase, but they're going to slow the rate at which they're increasing them. And they did suggest that that's what they were going to do at the meeting they did up in Jackson Hole. So I think they're going to stick to that. You're probably looking at 3 or 4 raises this year, just not in as much amounts.
Well, the market's already priced in 50 basis
Yes, it
points in
has.
February, so they're at least going to get that one. Well,
It certainly appears that.
Yeah.
That's the expected raise, yeah. But I think beyond that, I think they're going to have to. They absolutely have to slow down the rate of increase.
Yes,
they've gone too high,
Too far, too fast.
too fast.
Yep.
Because what's also going to be interesting is when the housing numbers really start coming out, because they raised rates so quickly, the economy hasn't really absorbed those interest rate hikes yet. It takes a while. The economy is not something that turns on a dime, right? It takes a while to absorb those things. And so you have interest rates, the housing market's really easy to use, right? Because we can look at mortgage rates that have gone from 2.5% to 7% on a 30-year mortgage. The number of people that are going to be moving now has dropped dramatically. I know plenty of realtors, and they've all told me there's a real decrease in activity on the housing front. Now, some will tell you some will be more honest than others, right? That's just kind of the nature of their business, right? Yeah, it's still a great time to buy a house. I get it, but it's not.
I heard that argument this week, actually.
Yeah, maybe if you're a cash buyer, actually, and you can buy something on the cheap. But the reality is a lot of that stuff hasn't been absorbed in the housing market, and we're going to see that with building because there's a very low supply of housing inventory right now. But people can't move because they can't afford to move. So we're going to see a drop in housing. We're going to see a correction in the housing market. It's gotten probably a little just way too wild. It's not maybe going to affect Louisville as much as it'll affect other larger cities, because just we didn't have the totally out of control market like some of these other places did. But go down to Florida, New York, California, right? We're going to have a serious correction in the housing market nationally, and so I think. Once again, this is all a result of the rise in interest rates, and so they're going to have to slow down the rate of increase. They're going to have to because it went too high too fast. So I think probably by the time you get to spring or summer, if it's not a pause, it's going to be another reduction in the increase.
Okay.
Yeah. So I'll take a little bit different spin on this. I think people get confused on what the role of the Federal Reserve really is. I'm not going to go down that path because that's a whole separate.
That's a long.
That's a separate
podcast
conversation.
right there,
But one of the roles of the Federal Reserve is to control inflation, or I'm sorry, recession. Right. That's what that's one of the things that they try to offset is a recession. I'll give you a quick example. 2020, we were headed to a recession, a hard recession. If not, probably a depression by definition would be my guess.
Everything that happened this past year should have happened in 2020, basically.
If not a lot worse.
Exactly.
If not a lot worse.
Exactly, yeah.
But the Federal Reserve did what they were supposed to do. They stepped in and they created lots of money and said, here's our policy. We're going to take it to zero. I mean, banks go out and lend money like crazy, and banks did. They lend money like crazy because they didn't have to pay this overnight lending rate, which is the Fed funds rate.
Yep.
And so it just created this plenty of cash flow out in the market, and everybody kind of offset a recession. It's the same way. They can use their policy to reduce inflation or help control inflation. Now, how do they do that? Again, for another conversation, but essentially they make it tougher to borrow money.
Right.
And so there's less money out, and therefore people don't have money in their pockets, and we start to not buy as much, and then whatever. So I think what the Federal Reserve is doing right now is they are trying their best. Nothing they've done so far has worked. So they've increased their rate over the last couple of years, right? They've been doing it over the last couple of years, or last year or so.
Last year.
Last year. They're hoping that by doing that all the spenders would go out and we go, wait a minute, I'm going to not spend as much. I'm going to keep my finances in order. Well, what did we do? We went out and spent anyway, right? And now there's lots of argument on why we're doing that, but we did it anyway. We just went out and spent money. And so the Federal Reserve has to do something to get inflation under control. That's one of their roles, is to maintain inflation. So I really do believe the Federal Reserve is going to be super aggressive. I think they're still going to be aggressive. I think we're probably going to get 50 in February. I think we're going to get another 50 in the first week of April, I believe, is their
Something
next
like
meeting.
that, yeah.
Second week of April. But I think they're going to do another 50. I think they're going to get a series of 2 or 3 that are in the 50s. The reason I say that is because they want this economy to go into a recession, and not a recession we had last year. They want it to be a full-blown, lots of layoffs, that type of recession. The reason why is because at that point, when the news starts to get around, what are we all going to start doing? We didn't get the news last year. Was like, in a recession, but it's no big deal. No big deal. We're in an election cycle, so
Right.
no big deal.
Still spending money.
And so we all went out and spent money. They were like, we're in a recession. Remember, they didn't really even call it a recession last year. They were using all these different terminologies.
Well, it was an election year.
Yeah, exactly. So I think the Federal Reserve is trying to, let's get a recession that's going to smack some people in the face, and therefore we're all going to stop spending, and so therefore inventories can start to build. That's been the problem, right? So when inventories start to build, what do suppliers have to do? They have to drop their
prices, right?
to get their inventories to start shrinking, and so I think the Federal Reserve is not going to play nice. I think they're going to still be fairly aggressive. I think their language could be softer, that we may be a little bit more accommodative, but I don't think they're going to be. But I do believe they're going to be a little bit more aggressive, probably till mid-year, and then towards the end of the year, I think they're going to start lowering because I think we're going to be kicked in the pants.
Okay.
But again, recession-wise, I think we're going to be in a recession the first two quarters, but then I think third quarter and fourth quarter are going to be really good.
And just to
really
clarify, when you talk about we're going to get beat up by the Fed, that's a good thing because that's how you get long term. That's how you get the inflation under control, right?
Well, yeah.
I mean, that's the end game, is to get that inflation rate back down to what they say they wanted 2.4 or something like that.
Yeah, but again, I hear you and I understand, but again, that denominator number has
Right.
to come into play too, and so over the course of the next 6 months, it will by default come down because the numbers start to tail off.
Well, because now we're looking at, when you look at year-over-year inflation, we're looking at last January versus today. Well, the inflation was already on the rise a
Yep.
year ago. So by the time we get to summer, when inflation was at its peak last year, the inflation numbers are going to be coming down. Maybe they're not going to be down quite as much. I don't know if they'll be down quite as much as 2.5%, but the numbers will be substantially better. But once again, inflation is still going to be very high. The rate of increase is decreasing.
Right.
So
Yeah.
that's the kind of the takeaway.
Yeah, exactly.
But yeah, so you're probably a little more aggressive on Fed policy. I'm probably less aggressive. Obviously, differing minds. You're right. We can both come to reasonable conclusions different ways. But that's what's interesting. We don't know. At the end of the day,
right.
we
Yeah.
don't know. We
Yeah.
don't have a clue.
That was the whole point of this discussion.
Yeah. No. Yeah. For sure.
And we'll come back here a year from now. We'll say,
Yeah.
how right were we when we all
Yeah.
sat down and made these stupid predictions? And
maybe we'll do one mid-year or something.
Yeah.
That way we can see, where we are mid-year. But either way, look, at the end of the day, no one knows, and that's
Right.
kind of why we're in this business. No one knows, and that's why we have when we create portfolios, it's all about risk on, risk off assets and making sure we have enough money to accommodate your lifestyle, for 3 to 15 years, depending on what we're trying to accomplish. So clients that come in, that we have this set up, doesn't really matter what happens next year because we have the cash sitting aside to cover all their lifestyle needs, and that's what we do with everybody. So. That's it for 2023 prediction, I believe.
Yeah.
Right? No other comments or stories or anything? No? Okay. All right. So that's it for this podcast. I believe next podcast is about Secure Act 2.0, 2.0, 20.0, 2.0. Yeah, 2.0. I knew it was something like that. I'm looking over here to something like, is that 2? Yeah, it is 2.0. But anyway, make sure you tune in that. There's some significant changes.
Yes, there are.
Especially for those folks that are, in their early 70s, there's a couple of significant changes for you guys. So make sure you tune in for next week. And sorry, if you do follow us, we are a little bit light on content in the month of December, and that's just scheduling and that kind of thing. We took some time off to be a family, so which is important to us. So anyway, we're back at it hard now, and we'll make sure we get content every week. But that's it for this week, and I'll let Eric sign us off for this week.
Yep. Thanks for watching. Thanks for listening. If you're watching on YouTube, make sure you hit the subscribe button. Feel free to share our content with anybody that you think might benefit from any of our ramblings that might be coming out of our mouth at any given time. So appreciate it. See you next time.